what's your stop loss? And this is exactly what it'll look like when you ask your trader that. Coming up next, let's talk about what is your stop loss, how to calculate it, and everything that goes into the stop loss. Can anyone answer that question? What is your stop loss? Nobody ever wants to tell you what's your stop loss, because nobody ever wants to lose money and nobody ever wants to be wrong. Coming up next. Should I buy the stock? Should I short the stock? Should I hold on to my position? Should I close my position? Trade small, think big. Learn the psychology to become a successful stock trader. Hello everyone, and as you heard, one of the most hated questions traders do not like to be asked outside of what's their edge and what's their secret, because that takes so many years to get good at and to discover in your trading. So it's very difficult for traders just to kind of give away their secret sauce, like they say. But the second, outside of that, of how much money you made today, or what's your account size, or did you make money, or you're profitable, outside of that, which is those legitimate questions, but the most hated question you can ever ask a trader, regardless of who they are, is what's your stop loss? Why is that such an uncomfortable question? The reason is most traders do not have a stop loss, meaning they do not know their stop loss. They do not know how much they're willing to risk on this particular trade if everything goes wrong. Therefore, if you ask a trader what's your stop loss and they don't know, it's uncomfortable because it makes them feel inadequate. It makes them feel they don't know what they're doing and they're not professional enough and they're not taking their trading serious. The other reason is people don't like to tell you their stop loss, because then they're basically admitting that they're wrong. And that's one of the biggest, let's say, ego hit, being wrong in the market. Now, I'll cover that in another video, but for this video, what's your stop loss? Ask a trader what's your stop loss. If they don't know, they're not taking it serious. Every trader and every trade should have a stop loss, because you're dealing with probabilities and you do not know the outcome. Yes, there are certain situations where the outcome is higher in your favor, going in your favor, than others, but it still needs a stop loss. That does not mean that all your trades are guaranteed. What's your stop loss? Can anybody answer that question? Anybody? As long as you know your stop loss, even if it's a mental stop, most traders who are very advanced have mental stops for a variety of reasons. But if you're a new trader, if you're just kind of practicing, or you must have a stop so you understand how it's executed. You could understand how sometimes it doesn't get executed and you actually lose more than what you intended to. If there's a huge gap down or some news, it could really affect, or sometimes your stop loss, depending on your platform, doesn't get triggered, and you open up your platform and you look at your P&L and you still have an open position, weirdly. Yeah, it has happened. It does happen. Does it happen often? Well, the more you trade, you'll understand. Those are kind of personal questions, and depending on the platform you use, but it is very possible to lose more than what you intended to, even though you have a stop loss in place. So therefore, it's very important to understand how much money am I willing to risk on this trade, because you're dealing with probabilities and it's not a 100% outcome. You need to understand that you're placing bets, and with a high probability that something's going to go in your favor. Therefore, you don't know the outcome, you cannot control the outcome. Therefore, you need to give yourself a chance that loss is not big, that it affects your account size, that you cannot place other bets or other trades. Therefore, you need to limit your risk, and everything needs to be sized. It's actually sometimes better that you gamble at a casino, because it's your bets are actually predefined, right? You go to whatever, blackjack. I don't really gamble, but if anybody else who gambles, if there's a predefined bet where you say, hey, I'm going to put $100 and that's all I'm going to lose, that's fine. But the thing with trading is most traders will put, let's say, a $2,000-$3,000 trade and say, hey, I'm only going to lose $500 on this trade, and they don't have the discipline to close out that trade when it hits a $500 loss. They start looking at the market and they start saying, hey, maybe I can get a $300 loss, maybe I'll close it at 200. Many times it goes to 200, 300, what you wanted, a smaller loss than 500, and you still don't close out. Why? Because you think, you know what, maybe it'll start running up. You know, these are the decisions that you start making while you're trading that has nothing to do with textbook. You can tell someone, a trader, you can read it, you can look at many videos, but until you're in the line of fire, you're going to know how you react when those numbers are moving. And depending on stocks you're trading, they're going to be moving very, very fast, and you have to make decisions very, very fast. You cannot freeze. So therefore, having a predefined risk is super, super important. Super, super, super important. Now, the other thing also that I want to talk about is how to calculate a stop loss. Now, there are a few ways to calculate a stop loss, but let's just give you the basics. Number one, you need to know how much are you willing to risk on this trade, and you want to compare that to the size of your account. Do not risk a lot or a big portion of your account to try and make a home run or trade. You know, we all know a lot of home run hitters, what happens, they strike out a lot. So if you play for the base hits, the doubles, the singles, and the triples, will the market give you a home run trade? Yes, because even in baseball, you have to wait for the home run pitch, and you can't swing every single time for the home run because you end up striking out a lot. So the very first aspect of a stop loss is how much you want to risk: 200, 500, 50 bucks, 1,000, to die. And all depends on your account size. The second component that not too many people talk about, the second component is very, 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 very important. The second component: how fast do you want to lose that money? How fast? That is crucial. Crucial. Why? Because it comes up to the third thing. The third thing is that'll help you analyze how you're gonna position yourself in the stock market when you enter that trade. If you're a stock trader like most people are, and you are willing to lose 500, well, how fast, if you put in 500 shares, or you put in 1,000 shares, the stock only has to move 50 cents against you. Now, if you're trading on Google, that's going to happen in seconds. If you trade at Microsoft or a slower moving stock, let's say, Wix, or VIX, no, Wix, sorry about that, VIX, or any other stock, Microsoft, or just a slow mover stock, 10, 15, 20 bucks, you can really get away with that. You can get away with the fact that, okay, I have 1,000 shares. Well, it has to go against me by a lot because the stocks don't move. So, okay, if you see that a stock moves a lot during the day, with the range and everything, then you have to position yourself. Hey, I could only do 200 shares, and I'm willing to lose 1,000. That means I'm willing for this stock to go against me $10, for example. Right now, you have $10 worth of cushion, or 10 points. Let's say you say you bought the stock at 30, and you're willing for it to go down to 20, for example, just for the number's sake. And you say, you know what? If it goes down to 20, I'm out. I'll lose 1,000. I'm perfectly fine. And that stock may take a very long time for it to go down to 20. It could take a month or 2 months, and that's how you calculate the speed at which you want to lose your $1,000. And that's the same thing with anything. You must understand how much you're going to lose, number one, and how fast can you lose it. That leads to point number three. Once you got 1 and 2, 3 is that'll give you your position size. Once you have those 3 components, you can enter any trade. And it's not a problem to enter a trade because you know how much it's going to affect your account if all these trades go wrong, if they all go against you. Now, you have to do this with all your trades. So if you have multiple trades on the table, and let's say you have 5 open trades and you're willing to lose 1,000 on each, well, if everything goes wrong and the market goes against you, and let's say you're all long, and the market starts going down, so you're willing to lose $5,000. What does $5,000, if everything goes wrong and all your stop loss gets hit, what does that represent to your account? Are you still going to be able to trade the next couple of days, or are you going to blow up your account? Why? Because the trade did not work. Remember, if the trade did not work that day, that week, or that month, does not mean it's not going to work another time. Therefore, you have to be able to absorb the punch, absorb the losses, and have an account for you to enter the trade when your trigger gets or your edge gets triggered again, and you can place that trade again. And you can, if you're risking 5,000, you need to 2-to-1, a minimum 2-to-1. So you were risking 5,000 to try and make 10,000, and if it works out, then you maybe make 10,000, 15,000. But you cannot have free, basically no trades with no stop losses and just no criteria. If everything goes wrong, you're going to be fine. No edge is 100%. Yes, there are edges where it's high probability, but going forward, ask yourself, what is my stop loss? Don't be fearful. Don't be fearful about having a stop loss. Don't think about it as hey, I can't be wrong because it might go against me. I mean, it might go for me if I stop it out. If that's the case, then I challenge you to do this. If you believe that, you say, hey, I get stopped out and it goes in my direction. Okay, if that's the case, challenge yourself. Get a piece of paper, write down your trade, which most people don't even do that. Most traders don't even write down their trades or keep a log, which is something else that I could talk about in another video. But keep a track record. You place a trade and you say, okay, well, this one I got stopped out and it went against me. If you find out that there's a high probability that a lot of your trades get stopped out and they go for you, let's say 60-70%, there's ways to strategize for that to not happen, or for you to take advantage of the data you just discovered. So this is all numbers. This is all putting the percentages in your favor. It's all it's all about putting the advantage, whatever that little advantage may be, in your corner when the market gives you an opportunity to take advantage of it. But at the end of the day, like the famous saying, you do not control the direction of the stock. You cannot control the direction of the stock unless you're a very, very big trader. But most traders are not that big, so you cannot control the stock. Therefore, when you place the trade, you've already done your job. You've already done your job, and now the market has to do its job. And therefore, if the market does its job, then your job is to place the trade. When your edge gets triggered, what's your stop loss? How much you're willing to lose on this trade? How fast can I lose it? And how to scale for me to lose that. If I'm willing to lose 500, well, I'm only willing to do 100 shares on this stock. That'll give me a lot of cushion for my edge. Give it time to work. There's a lot of fake outs, right? Because you were wondering, no, it could go in my favor. It could go in my favor. Okay, well, if you have a correct size, you can have that fake out. You can have the stock work in your favor and give it the time that it needs for it to work, to work out the fakes, or for you to say, you know what, it's not working, or it is working because this is a fake out. You're not going to feel pressured. You're not going to feel pressured into getting out of the stock. And if the stock is not working, if your trigger or the edge, is not working at that particular moment, there is no fear, because you know what you're going to lose, and you know how long it's going to take you to lose that. Don't lose $500 in a minute. Don't do that. Don't lose $1,000 in 2 minutes. That's not trading. That's pure gambling. And if even a step further, if you're losing $1,000, were you going to really hold that trade for you to make $2,000, $3,000, $4,000, $5,000? That's the question. So next time, ask a trader. Don't be the person say, hey, what's your stop loss? And you don't know. Don't know. Know your stop loss. Be professional. Protect your hard-earned money, because if you're trading, you know how fast money can be lost. A lot of people talk about how fast you can make profits, or all this other stuff. Yes, because those traders that you see, they're seasoned. They've been around for a while. But at the same time, it takes minutes, hours to lose hundreds or thousands of dollars that has taken you months or years to save up. And you want to go and say, you know what, I think I'm going to try and make a few $1,000s and lose a few $1,000s. How long did it take you to save up that money? Where did you get the money to trade? Did you borrow it? Did you save it? Did you take out debt, credit cards? Really understand. The other thing that I really, really want you to focus on is you don't lose that money so fast. Why? The more you're in the market, the more you're trading live, even if it's small positions, you're able to learn. You're able to learn more how your edge works. So a stop loss is a study guide. It, if let's get truthful here, all professional traders, when they find an edge, or they're given an edge, or they discover an edge, they paper trade it for a while to make sure that it works under certain circumstances. When does it work? When does it work better? How often does it work? They don't go just put live money in it. They do research on their edge, and one of the research is stop loss, risk reward. How often do they get stopped out? How often does their profit get hit, or how they need to know. They need to know all these little details about the edge that they discovered before they put it in a live market, before they put their hard-earned money at risk. All right, so hope this helped. Please comment on the bottom if you want to, just subscribe. Subscribe. And if you have any ideas for new videos or any other subjects you want me to talk about, you can always leave a comment below. I'll do my best to reply. If you need a more extensive reply, email me at TradeSmallThinkBig@gmail.com. TradeSmallThinkBig@gmail.com. And I'm gonna leave you off with this message. What is your stop loss? How fast you're willing to lose the money? How fast you're willing to lose the money? Size correctly for the top two. All right. Be safe in the markets.